Welcome to our channel, Stock Market Analyst. Today, we're diving into the key differences between the stock market and the bond market. By the end of this video, you'll have a clear understanding of what these markets are, how they work, and why they matter for your investment strategy. What is the stock market? First, let's talk about the stock market. A stock represents ownership in a company. When you buy a stock, you're buying a small piece of that company. Think of it like owning a share of a pizza. If the company does well, your piece could become more valuable. Stocks are usually traded on exchanges like the New York Stock Exchange, NYSE, or NASDAQ. They come with the potential for high returns, but there's also a lot of risk. Stock prices can go up and down based on how well the company is doing, market conditions, economic performance, or company news. What is the bond market? Now, let's move on to the bond market. A bond is essentially a loan that you give to a company or government. When you buy a bond, you're lending your money to them for a fixed period in exchange for interest payments. It's like when you lend money to a friend and they promise to pay you back with a little extra for your trouble. Unlike stocks, bonds do not give you ownership in the company or government issuing them. Instead, they are a formal agreement where you get paid back the principal amount, the amount you invested, at the end of the term, plus periodic interest payments. Key differences between stock market and bond market. Now that we know what stocks and bonds are, let's compare them side by side. 1. Ownership versus lending. Stocks. When you buy stocks, you own a piece of the company. Bonds. When you buy bonds, you're lending money to the company or government in exchange for interest payments. 2. Risk. Stocks. Stocks have higher potential returns, but they also come with higher risk. Stock prices can go up or down quickly depending on market conditions. Bonds. Bonds are generally safer investments. You know how much interest you'll earn, and your principal is paid back at the end of the term. However, bond prices can still fluctuate, especially if interest rates change or if the issuer is struggling financially. 3. Returns. Stocks. The return on stocks can be very high, especially if the company grows and its stock price increases. But the risk of losing money is also higher. Bonds. The return on bonds is more predictable, usually in the form of fixed interest payments. You may not get the huge gains that stocks offer, but you also have a more stable investment. 4. Market behavior. Stocks. The stock market is much more volatile. Stock prices can fluctuate based on company performance, economic news, or even investor sentiment. Bonds. The bond market is less volatile, but it still responds to factors like interest rates, inflation, and the financial health of the issuer. 5. Income generation. Stocks. Stocks can provide capital appreciation. When the stock price increases, and some stocks pay dividends, a portion of the company's profits. Bonds. Bonds provide interest income at regular intervals, which can be an appealing feature for income-focused investors. Which one should you choose? So, which market should you choose for your investment? Well, it depends on your financial goals and risk tolerance. Investment goals. If you're looking for higher returns and are comfortable with some volatility, the stock market might be a better option for you. Stocks are ideal for long-term growth if you're willing to ride out the ups and downs. Risk tolerance. If you prefer a more stable investment with predictable returns, the bond market might be more suitable. Bonds are generally safer and provide regular interest income, making them a good choice for conservative investors. Time horizon. Stocks are often better suited for long-term investors who can ride out market fluctuations. Bonds can be suitable for both short-term and long-term investors, depending on the bond's maturity and interest rate environment. Practical example. Let's look at a practical example. Here's a comparison of a stock like Apple and a bond issued by the US government. Notice how Apple's stock price can fluctuate based on its performance and market conditions, while the US government bond provides a fixed interest payment and returns the principal at maturity. By understanding these differences, you can decide which investment aligns with your goals. To sum up, the stock market and bond market offer different opportunities and risks. Stocks provide ownership in a company and the potential for high returns, but they come with higher volatility. Bonds offer a more stable investment with predictable returns, but they may not provide the same level of growth as stocks. By understanding these key differences, you can make more informed decisions about where to invest your money. That's a wrap on our guide to the key differences between the stock market and the bond market. If you found this video helpful, please give it a thumbs up, subscribe to our channel, and share it with your friends. Drop them in the comments below. Happy investing!